the summer, tech companies like Meta made headlines for their eye-watering offerings they were making to potential talent to join their team. We're talking packages of up to $250 million for a salary offering. Now, startups, they can't really do that. And while startups have never been able to compete with big tech when it comes to those salary figures, they have been able to still recruit top talent by other means, building up benefits packages with things like employee equity and other types of benefits as well. But given what we are seeing with the race for top talent, as we are seeing that happening with the unfolding of AI, has building good compensation packages gotten even that much harder for startups? Randi, we're going to kick it off with you.
Well, excited to be here. I'm Randi. I'm the head of talent and operations at 645 Ventures. We are a VC firm in New York and San Francisco. It's a loaded question. There's a lot going on around compensation these days. I think the one thing for startups to continue to think about is what's the most important thing when you're hiring for these folks, and think about the profile of the person that you're looking to bring on. What the OpenAIs and the big companies of the world may be looking to hire for and what they can afford ultimately will look very different from what a startup can do, and we'll dig a lot more into that. But yes, it's very real.
Of course. And before we do dive too far into it, just a note that there will be Q&A for the last 10 minutes. So as we're going through this panel, if you're thinking of something or a question comes to mind, definitely keep it in your mind. I'll open it up with about 10 minutes left, and someone will come over and give you a microphone. But before we get too far into the nuance here, Rebecca, walk us through what should companies even think about when they're just getting started and they're like, you know what, maybe I want to offer my employees equity at some point. What should they know?
Thanks so much, Becca. So I'm Rebecca Lee Whiting. I'm a fractional general counsel for early stage startups in my own firm, Epigram Legal PC. I think it's a great question, and something I really want to impress upon founders in those early days is to avoid what I call legal tech debt, right? You don't want to do things without making sure that you're doing things compliantly, and that would ideally mean speaking with a lawyer with experience in this area. So one of the things you're going to want to do for your very early employees is consider whether or not you're going to let them buy restricted stock directly from the company, or you're going to go through the process of setting up your employee stock option pool. Most people do the latter. They set up a plan, they set up a pool, and then they issue options. In order to issue options out of a plan compliantly, you need to get something called a 409A valuation, which is an assessment by a third party of the fair market value of the stock, so you can figure out what that strike price is, what the employee will be able to exercise at. And another consideration that you're also going to want to have for your early employees, not necessarily for everybody, but for key hires, is whether or not you're going to allow them to early exercise, which allows them potentially to lock in a tax benefit called the 83B election, where they won't pay any difference on the gain of the stock. So these are all questions that you're going to want to talk through with a general corporate lawyer who can help you understand what it is you need to do to be able to offer stock to early employees. And I think it's really important because this is one of the ways that startups can compete with the big guys, is they can offer the potential to early folks to really participate in a larger slice of the pie.
Mm-hmm. And Yin, I know you have an interesting look into this space, of course, as a startup founder, but also as a startup founder of a company that helps companies with this process. So maybe if you want to tell us a little bit about what are you seeing in the data? What are companies doing? Sort of like, what are the trends there of what people are doing currently in this space?
Yeah, it's interesting when you mention that startups are looking to compete with large tech companies, because I think the reality is that you can't compete. $250 million is not an offer, it's an acquisition that most companies would be ecstatic to be able to receive. And what we've seen is that when companies are trying to make their offers competitive with startups, it ends up being a lose-lose situation, because for the person that's looking to join a startup, they're not looking to work at a large company. They're not looking for necessarily stability. They're looking for owning a small piece of something that could grow much more into the future. And when we think about equity, and I think so many of the companies on our platform, what they've seen is that in order to be competitive, you're almost promising the future of what could exist. You're not looking to start at 99th percentile compensation. That's not a business model that I think any startup can go and compete against. But what you can grow into is have everyone in your company be at the 99th percentile because the value of their equity has grown, and that's something that you build together too.
Anything to add? No? Nothing to add? Okay. And I think one thing we talked a little bit about when we were doing the prep call is sort of, you mentioned, of course, there's the legal pitfalls companies can fall under when they are setting up these types of equity programs. But there's also some of the other, not necessarily pitfalls, but things to consider. I know one of the things we talked about is how much equity you'll be able to give out before VCs are going to be concerned about your own ownership stake. And that is very different if you are a solo founder, if you're 2 founders, if you're 3 founders, et cetera. Maybe if you guys want to talk a little bit about those kind of factors and things that companies should be thinking about from the front. That's not necessarily the hard legal side, but the other things that could kind of bite them down the line.
I can start. I think one thing is early on, founders really want to think about how do I set a precedent and what's my process and how am I going to do this structurally for every single first few hires that I make. I think it's really important to think about not just that process, and don't worry about the process at the early stage. Think about who are the people you're trying to hire and what is going to incentivize them to take that offer. It's not something that you have to get right out of the gate. You will likely have to do cleanup post the Series B, and acknowledging that is okay, but don't try and get it perfect out of the gate when you're hiring your first few people.
Yeah, I mean, I think this is something where it really depends, right? Like you were talking about co-founders, right? Sometimes VCs want to see a really even split between co-founders if they really are kind of rowing with the same oar. Sometimes it makes sense for one person to have more. It really depends on your individual situation. I can tell you what's typical is that, usually founders are setting aside 10 to 20% for their employee pool, and expecting that the biggest key hires are going to get a larger slice of that equity that's been set aside. And as Randy said, you can always adjust later, right? There are a lot of opportunities to refresh. You're going to refresh your pool basically almost at every fundraise. And you're going to think about how you keep giving new grants to folks who are key and who are performing well to incentivize them to continue to work well for the company and to hopefully share in that gain at the end. So I think that's really important to, as Randy said, you don't have to get it perfect, but having a sense strategically of where you want to go, understanding your kind of levels and benchmarking early on, I think is really important, and thinking about it strategically, and thinking about like who are really the key hires and who should get the most, while also paying attention to matters of equity, not startup equity, but in California here we have something called the Equal Pay Act that requires that people of opposite genders are paid equally for the same work, and equity is now part of that law, explicitly under California law now. And so I think that's also important, thinking about levels and thinking about like who are the key hires and how do we make sure that we spread the equity of the company appropriately amongst those levels and departments.
Yeah, I agree with everything that Randy and Rebecca have said. I think my pretty strong opinion when it comes to equity for a startup is that you should be more generous than what you think you should be. I think it is unlikely, if the company is really successful, you're going to look back and say, like, man, I gave away too much equity to everyone that was at my company trying to make this company really successful. The part about dilution that I think that sometimes gets overlooked is that the reason the dilution aspect matters is when you're thinking about fundraising and capital raising for your company in future rounds. When you're at the seed round, a Series A, Series B, Series C. What you don't want to be in a position is when you go into the Series C, and investors are looking at you and your co-founder and thinking, wow, you guys only own a couple percentage each. Are you actually motivated to still continue to grow and build that company? So that's the perspective on when investors are looking at it and say you've been over-diluted. It's usually not you've given away too much to all of your employees. And I think the counter against that is that you should take a look, understand what your ownership is, and make a plan. Based on what your ownership is today, based on how much is in your employee option pool, how much do you expect to get diluted in future rounds? Obviously, the macro, the industry you're in, all is going to factor into what that picture looks like in the future. But looking at it, I think, allows you to be able to protect against the downside there.
Yeah, I would say that the much bigger risk in terms of the dilution is going to be from your investors, not from your employees.
Yeah.
So.
And I guess I would say, like, outside of dilution, right, I think it's all about what you're trying to do. It costs a lot of money to give equity, and so you don't want to lose that in this exercise, and you want to remember how much there could be, as we're all kind of alluding to, into the future. But really think about, like, how do you get people to value that equity out of the gate and make sure that, you have those right conversations.
And maybe just one point, I think echoing on that, when you say like looking at it from a fairness perspective, what I would expect is that people within your company, especially as you're going to grow, will talk about compensation. And what you want to position yourself in is one where, as you're talking about compensation, everyone at the company also feels like it's fair. Because that's one where it's like, wait a minute, this person joined the company. It feels like that isn't quite fair to the package that I ended up receiving. Especially when it comes to equity comp, it can be really confusing. So having frameworks here can help. So when Pulley was just getting started, we were early days, we just raised our seed round, our approach when it came to total compensation was that we would pay in the 50th percentile when it came to cash, but 90th when it came to equity. And having this framework allowed us to be able to grow and say, like, great, as the company continues to do well, 90th in terms of actual number of shares you receive is going to differ because the value of the companies differ, but that framework still applied.
You brought up a good point, too, that I wanted to touch on, is that oftentimes when we have these kind of conversations about compensation for employees, especially on the equity side, we always talk about not giving away too much, not diluting yourself too much, but we also don't talk about the flip side of how should companies think about approaching when it's like this hire would make or break the company at the stage? Like, do we want to give them more than we would think about doing normally? And sort of like, how should companies think about navigating those scenarios where it may make sense to go and offer more than maybe they were expecting from the beginning?
Yeah, I think this is one place, it's around kind of grounding ourselves as first-time founders. Many people don't want to have the difficult conversations. So if you're going to go ahead and give the larger equity grant, that may be okay if you are, like I would say, you should scale up on equity, scale down on cash. That's the goal. But if you're going to have to give a larger equity grant, and even if it is a regular size equity grant, make sure that there are clear goals for that person, make sure you're holding them accountable, and make sure that you understand what the implications are from a vesting and cliff standpoint. Because that's where, if you don't move quickly, if someone's underperforming, that's equity that you'll never get back if they fully vested. So make sure that there's very clear accountability, there's clear goals, you are not just surpassing, and you're very aware of all of those cliffs. So if you have to make difficult decisions, you're kind of aligning that to the timeline that's against that employee's journey.
I would agree with that also, right? Better to fail fast, right? If you're going to and people will make mistakes, right? You'll think that this is the perfect person, and it turns out that it didn't work out. That's okay, right? But making sure that you do adjust quickly, and you don't want to do it on the eve of their cliff date either, right? That doesn't look good, right? When someone's put in almost a full year, right? Better to do it, in the first 6 months if you're really giving it a trial. And I totally agree with having very clear guidelines, OKRs, what you want this person really to be doing, and to make sure that it aligns with your sense of like, is this person going to be, a 10x value add? Are they actually proving that out, right? Because I think we have a lot of ideas about what might be true in the future, like what might make the business, but businesses change, we're pivoting, we're moving, and so I think staying on top of that, as Randy said, I think is very important.
I also always say don't terminate someone on their birthday. So use the cliff dates as your own internal gut check, but I agree with you.
Yeah.
Make it put a little more polish around it.
I think two thoughts there. One is that you do have more levers than you may think, so be creative. The standard when it comes to equity is 4-year grants, 1-year cliff. If there is someone that you think is going to be critical to your company, see if you can potentially extend the number of years they're vesting. Snapchat for a while had done back-weighted vesting so that you can also align the value that they may be creating towards the later half if you think there is additional risk because what you're giving is additional grants. The other thing I think about is I think we can sometimes over-romanticize this idea of like this one key hire that's going to come and save everything at our company. And the reality may actually be you have really good people on your team already. And I think as folks on the panel have alluded to, don't forget the aspect of ensuring that you have a competitive refresher grant. Because having people stay at your company for a long time, having that tenure, and ensuring that they're continuing to stay motivated is just as key to building a great team as it is ensuring you can close new people to coming to the team.
I love the refresh grants because I think it's really easy out of the gate to think you could just give away the whole pie and give away as much as you think you need to at that moment. But don't lose that you can always give more. right? Like there's always more that you can go back and give. If somebody's working out really well and is like that God sent hire, then you can always give them another grant even well before the next grant comes due. So there's lots of ways that you can always give more. It's really hard to take it back. You frankly can't.
Yeah, it's very hard to take.
Yeah.
But they can give it back, but
Yeah.
that's not normally what happens. The only pushback I'd have with that is, something to keep in mind, right, is, you hope that the strike price, the fair market value of your stock is going up over time. And so it tends to be better for the employee to get the bolus of what they're going to get in terms of equity earlier so that they have a lower strike price. And so, yes, refresher grants I think are absolutely important. I think they should come along, but they tend to be smaller, and they should be smaller, right, because the value of the company is growing, right? So I think, I sometimes get folks who say, well, I want to like grant out, a quarter here, a quarter there, and do it over 4 years. I'm like, well, that's what the 4-year vest is for. So they're kind of misunderstanding that point. I do think a refresher grant is typical and important, but I do think you want to figure out what's the right level, what amount should this person generally have, and start there so that they do get the benefit of that lower strike price.
Yeah, and I agree with everything you said. When I think about refreshers, maybe this isn't the right word for it, is also when someone is promoted. I would look at it from a perspective of if you were to hire someone net new to join the company versus now you have someone on the team, what should their grant look like? And I think it should be one that's actually comparable across the team.
And I think one thing to think about too is it would be very easy if every time a company made a potential employee an offer, the employee said, yep, that sounds perfect, I will take it. But that is not generally what happens. So when thinking about structuring these different compensation packages, how should companies think about negotiating? Because they're probably going to get requests, oh, I would do this for a little more salary or a little more equity. And how should companies think of navigating that? And when should they know to walk away?
Want to start that one?
Sure. I mean, I think it's so hard, right? It's such an individualized question, right? Like if there really is somebody that you are convinced is, the perfect person for this role, and it's who you want, and they're asking for a little bit more, maybe it does make sense to negotiate. I think lots of companies do. The one area where this starts to get tricky, and I see this a lot, particularly having a background in employment law, right, is that we've looked at the studies, we know that men tend to ask for more and tend to negotiate and tend to get what they ask for, and women do not. And so that then leads to these kind of pay disparities that you see in companies where, if men are negotiating by and large and being given more and women are not, you suddenly start to have this kind of creeping gap, which then becomes, potentially an equal pay liability. It really is up to the company. I mean, I tend to think you want to come up with the best and fairest offer, and then consider negotiating on some points, right? If someone wants more equity and less cash, that's something where you can move the numbers around. But it's not just more, right? And so that's what I tend to think is typical practice and best practice, is think about how you can kind of move different levers around to create a package the candidate is most excited about, while still staying true to your standards, your plan, your strategy in terms of comp. I don't know what you guys think.
Yeah, I was a former operator, and there were moments where we would craft two very different offers. One was, much higher on the base salary and lower on the equity, and the other one was the opposite. And our goal, obviously, through our recruiting process was to know what drives and motivates people so that when we put that offer in front of them, it was the right one. But there were times where it became a conversation and we had to say, well, we can do option A or option B. And ideally, they understood the two choices and would pick what was right for them based on what their risk tolerance was and how important cash was for them at that stage in their life.
Yeah, I agree, and I would say, ideally, you shouldn't be in the position of, at the last minute, of having a surprise.
Yeah.
Like, oh, but I want this one other thing. I think of this more as the whole recruiting process, where if it's like you're trying to understand the candidate, early on, I think understanding what matters to them. Are they in a stage in their life where they're like, hey, look, I really need a high salary because I have kids at home to take care of? If it's the case you're like, look, I just got a really amazing acquisition for my last startup, and I'm ready to go all in on equity for the next one, then knowing that allows you to be able to craft a package that's far more compelling. One of the things that we did early on is, when we come to that last conversation with a candidate, ask a question of, assuming we get there on the numbers, are you a yes? Because then you can figure out everything else, like the culture, the people, the team, what they're going to be working on. That ends up being the day-to-day. This is a number, so that you can then focus on the number, get that done, but really I think focusing on everything else ends up being key too.
And something that's interesting to talk about in the current moment we're in is for multiple years, of course, there was a global pandemic. Most people here are aware. People were working from home, and people working from home meant people were not necessarily getting paid the same salaries if they were getting a new job that they would have if they were working in San Francisco, in New York, versus working remotely across the country. How does that play an element here? Because we mentioned earlier, of course, people at companies talk. They talk about how much money they're making. People compare salaries, and people compare that type of compensation data. How did return to work and sort of that period of time where people probably were getting paid wildly different at the same company, same role, how does that impact these kind of conversations we're having today?
You want to start?
Yeah, I can, it's complicated, I would say, is maybe the starting point to it. And I think a lot of folks are still figuring it out. I could probably play devil's advocate and argue every single case where you could have equal pay for equal work no matter where you are, because everyone is logging onto the same Zoom screen, then you should have equal compensation. The downside of that is that there is, like you could say, an ephemeral aspect of people being in office together. San Francisco has a higher cost of living. New York has a higher cost of living. For some of the work that you do, is there a serendipity that you get that you don't get when everyone is remote, so that you have a premium that you pay for certain areas where the company has an office? I think it comes down to there's not a right answer for every company, and I hate that we keep on repeating that because I think it's the reality. There's not a right answer for each company. But the framework that to apply is what is a consistency that you want to apply? What you don't want is that certain folks in certain regions end up having a different compensation structure than other folks elsewhere. And I think added on to all of that is that the first question you asked was around, well, it's so competitive to hire really good people. It can be a competitive advantage if you say, hey, we want to be able to pay people the same amount no matter where we are and hire the best talent that we can in Texas. But at the same time, for certain things like AI talent, you need to pay top of band no matter where they are, because the amount of folks that can do that work ends up being really few. So have a policy and framework and try to stick with it as much as you can.
I think this might also be a good time to talk about the other things that you can do other than comp and equity to make an offer attractive to people, right? And so some of that is flexibility. I think coming out of the pandemic, a lot of people are expecting more of a hybrid work environment than full-time return to office, and maybe some flexibility around where they do that work. And so that could be another way that you could tackle that problem. I totally agree with what Yin said as well, that you need to think globally about your strategy and how you are leveling people and hiring across the country if you are a company that has multiple locations. But yeah, I think thinking about flexibility and other kinds of benefits can also be a kind of tool in your toolkit as a founder.
I find that from a geography standpoint, most people they benchmark New York, San Francisco, and then everything else. But I think that, right?
Right.
But I think in the markets that we're in, I think New York and San Francisco are now kind of one entity in terms of the data that you'll see, and then the rest of the country, and I'm not saying that's right or wrong. The guidance I give to our portfolio companies or even to our firm is to try and think about it holistically, right? If we're going to hire a software engineer who's based in Utah, we're likely going to be paying similar prices than we would in New York or San Francisco. And so just having that, clear guidance and thinking about it all as one, as opposed to trying to chop the country up into different pieces and different regions and then look into the data sets to see what that looks like. It's all going to be directional, and so just use that as a starting point. And I go back to what I said earlier, but what was the goal? What are you trying to accomplish by doing this? Try not to get caught in the details.
I think that one thing I would add is I think one of the things that when I talk to founders about that I think sometimes you can overlook, because when you're early and scrappy, you're just trying to make things work, is that your compensation strategy should not be a people-based strategy. What do I mean by that? Don't try to over-optimize. When you mention hey, if you hire a software engineer in Utah, their cost of living in Utah is going to be different than someone who may even be, I don't know, in Nashville, Tennessee. But if you try to over-optimize on the individual, having that be something you try to scale is going to be insanely hard. If you have a per-state compensation strategy, it's okay, I would say maybe to be more generous. Pay the person more, because look at what is the role that you're hiring for and what is market for that role, rather than you found an outlier person that happens to be in Utah who will take lower lower comp, great. When you actually go and hire more people at that same level for senior engineers, and then they start to talk and say like, hey, why is my salary less? If you don't have a way to be able to respond to that, I think it ends up leading to not great trust building within your company.
Be more generous, but we said earlier, accountability, goals, hold people accountable, make difficult decisions more quickly if you're going to be more generous out of the gate.
And if you're gonna make mistakes, I think that's okay. It's, I think, oftentimes like expected as you continue to grow, but how you respond to it, I think, ends up being more important.
Definitely.
And I know we spent a lot of time talking about the equity aspect here. And before I dive into this next question, we're going to open it up for Q&A after this. So if you've got an idea, definitely raise your hand, and someone will come over with a mic, and I will kind of point people out at that point. But we've talked a lot about equity, but of course equity and even salary are not the only aspects of a compensation package here. And thinking about sort of things we've watched happen over the last year, we've seen a lot of really hot AI companies either get acquired a lot earlier than maybe we would have thought they would if this was 6 years ago. And they also are seeing a lot of acqui-hires of founders. And people are generally willing to come into these companies, take that lower salary, take that equity stake instead if they believe in the founder and if they believe in the mission, but the founder plays a big role in that. So if we continue to see trends like this where companies are exiting earlier than we thought, a big example I know a lot of people are talking about is what happened with Cognition and Windsurf, does that affect how willing talent is to ride on that equity going forward? Like, should startups think about other ways they can sort of make those compensation packages more attractive?
Yeah, when we initially, I think, started the conversation, a lot of times we're orienting what we're saying towards founders. So maybe taking an opportunity to flip that. As an employee, how would I think about it? I think one baseline perspective is that you have to bet on the people that you're going to be working for, which means doing your research on the founders and that you're going to be joining on this journey. 'Cause when we talk about what happened with Windsurf, I would say that may not actually be an anomaly. Like Pulley helps companies with their cap table and equity. We have every reason to try to get you guys on our platform. But at the same time, at the end of the day, when an acquisition happens, there can be so many things that happen that cause you to forget what the cap table actually looks like, depending on the structure of an acquisition. The acquiring company can decide to do a acqui-hire, where you dissolve the entity and you just go and hire the good people that you want at the company. By good, I mean like what the acquirer needs. So this is where I think the trust actually ends up mattering a lot. There's founders I know that when they've went through that situation, took the equity that they had, make sure everyone was trued up. But you're kind of depending on the trust in the individual here, I think, rather than necessarily just trust in a system.
Yeah, I mean, it is a trust fall, and I do think that these recent large acqui-hires have really kind of changed people's understanding of the fundamental bargain, right? Just that you're going to work really hard, earn that equity stake, do your 4 years, and then if there is an acquisition, you're going to participate in that upside. And these acqui-hires really, I think, have changed that. So I do think founders like have a role here in communicating to employees, what their expectations are, and reiterating that they intend to stand by that original bargain. And again, from the employee's perspective, another thing that people can ask for is single trigger acceleration, right? That's something where I think is really appropriate for line employees, less appropriate maybe for executives where double trigger is more the standard. But the understanding being that if there is an early acquisition, that employees will be fully vested out, and so they will participate as if they'd been there through the whole time, because you assume that it is the efforts of the entire company and not just the founders that has gotten to that successful acquisition. So I do think that we need a little bit of a correction here back towards what we originally, I think, set this up as, right? The employee stock option pool and sharing equity with employees was intended to incentivize everybody to work really hard, again, row with that same oar. And yeah, I hope that we're going to return to more of that and see less of this kind of I got mine attitude.
Mm-hmm. Anyone have any questions? Ooh, we do have questions. You guys were shy with your hands earlier. We'll start with this gentleman in the front row. Oh, perfect. They're bringing you a mic so we can all hear you.
Hi. This question's for Rebecca, obviously open to anyone else on the panel, but I'm curious, founders tend to be pretty cost sensitive early on and delay legal fees for as long as they possibly can. What are the reasons or triggers that you see people coming to you to formalize their cap table or how they do equity outside of just the 409A valuation that you mentioned earlier?
Yeah, so I mean, that's a great question. I think one of the things that's nice is a lot of the big firms that work with startups in this area are willing to give a deferral of at least a certain amount and a discount to startups, and so that's something to think about taking advantage of. It's also a great idea to think about working with, obviously I'm biased here, but solos and small firms that tend to charge at a lower rate, right? And also maybe sometimes are willing to agree to some kind of deal of either equity or a discount in order to work with folks who are very cash sensitive in those early days. I tend to have folks come to me when they have a dispute, right? Something where they're not sure how to work it out, or they've run into an issue where they can't figure out kind of what the next steps are. And so that's, it's really my honor to help people when they come into a problem where they can't figure it out. But again, I do encourage folks to at least have a conversation with a lawyer when you're thinking about setting it up. There's a lot of great tools out there that will help you set up your company quickly and mostly compliantly using tools that are available without having to talk to a lawyer. But people really run into issues where they said, originally we issued out equal equity to my co-founder and I, and now we've decided that actually a different split is appropriate. How do we fix that? That's not something you're going to be able to do on your own or with a lot of the tools that are out there. You really do need a lawyer to help. So when things like that kind of come up, or when you're doing your first hires, like just making sure that the forms that you got are appropriate. I've seen folks who are not in California opt into California law, which is the most employee protective in the nation, because they took some forms that they found available online that selected California law as the venue. That's not something that's necessarily a good idea if you're based in Texas, right? So again, I just encourage folks to talk to a lawyer early and often, and then try to work with that lawyer to make sure that they can level set and give you the services you need at the price that you can afford, and right size that for you.
I would also add that many VC firms have platform teams, and there could be some bundled relationships that are sitting at your fingertips with VCs that have already invested in you. So feel free to ask. They may have tools and resources available that may not cost you a whole lot.
Can't see super well. I've got someone, Oh, right next door.
Hi, how are you? I'm working with a company right now, and we're trying to figure out how to set up the options. So you mentioned 10 to 20% for new employees that you're trying to want to bring in. With my company, with the two co-founders that we have, we're trying to figure out what is the proper ratio between not only the two founders, but also for investors coming in. If you're looking at a company, what would be the numbers that you would set aside percentage-wise for the founders, for future investors, and then also the 10 to 20% that you mentioned for new employees?
Yeah, so the way that I think about a cap table, typically in the early days, it's usually we go out of 10 million because that's an easy round number, right? And so usually you're going to put aside either 8 to 9 million for those early founders, and then 1 to 2 million for the early employees. So that ends up being that 10 to 20% they were talking about. You don't need to leave room for your investors. That's going to happen through the natural process of dilution as you go through your fundraise. What you do want to pay attention to, right, is how much of the company you are selling away. And so modeling out with those safes or with other tools that you're figuring out, when you do that fundraise, how much have you sold of the company? So if it's 3 on 15, right, what does that mean in terms of future dilution? But if you're thinking about the early equity of the company, it's just at that 10 million. Yeah.
And maybe not to open a can of worms here, but I think, Rebecca, you'd be able to speak to this, is we talk a lot about ownership as it pertains to economic upside, and then there's also control. You can own, say, 50% of the company come your Series A, but you can still maintain control of the company based on how you structure voting rights on your board within your preferred shares as well. And going back to don't be penny wise and pound foolish, go and talk to a lawyer who can help you understand this so that you can set your company up for long-term success.
Yeah, I have a question which I know over here, either middle row.
Okay.
Yeah, I know the default answer is going to be it depends, and every situation is different. But I was looking for some ranges on the following. So we are two co-founders, just got started, going to hire our first maybe 2 or 3 technical hires. What is an actual percentage range that you would want to offer them? Is it 1%, 2%? What are good ranges that you've seen across all the companies you work with? And assume tech companies. So yeah.
We had done this was a couple years back, an aggregate survey across the platform looking at what is the ownership for early engineering hires. And it ranged anywhere from, so basically it was this curve downwards of 4, 3, 2, 1. And then for the first 10, folks, it was roughly like you would give away maybe 10% of the company. And again, I know it depends, and this was also a couple years back, and now you're looking at the alternative of AI in the mix of really good people. Their alternative is not to join you, but to start their own company. You may actually want to be more generous than that. So I would say there's the data that you can get from compensation platforms that can tell you how to benchmark. And then there's the data you can get from the candidates directly of telling you where is the market. I would actually weigh more towards listening to them and ask them what would make you really excited to be able to join the company too.
I think my only caveat on that is you can't ask about their past compensation.
Right.
What did you earn at that last role? That's not legal. But you can ask, what is your expectations for this role? So I agree with Yin, and I would really encourage people to look at those benchmarking tools, know what's market according to those benchmarking tools, but then also ask your candidates what they want. Yeah.
I think we have time for one last quick question. We've got someone right here in the front.
I don't need mine.
Oh.
So I have a couple of questions. First, how do you incentivize early employees when you're bootstrapping, where funding and valuation is not really a big concern at the moment? Second question is refresher versus longer vesting period. Like having worked at a startup myself, right? There are some cons where, let's say, if you have a 4-year vesting period, and then you get a refresher versus maybe 5 or 6-year vesting. So what are your thoughts there?
So I'll just repeat the question so other folks can hear. The first one is, how do you incentivize early employees if you're bootstrapping the company and you may not have a valuation?
Perfect. Anyone want to tackle that? We've got 40 seconds left, so the short version.
I want to go to the second question.
And the second one was, sorry, I actually didn't catch the second one.
Accelerated. Yeah, longer.
Versus long.
Yeah, what are the trade-offs when it comes to a longer vest? So maybe just tackling the second one really quickly is that longer vest is that you may not be able to close a candidate because it's very easy for them to say, look, the standard is 4-year, 1-year cliff. I have other options to be able to go to, or I can start my own company. But if they are really excited about joining, maybe that is a conversation you can have with them directly. And on the first one, how do you incentivize them? You're still painting a picture of what the growth of the company could be. I actually think joining in the bootstrap phase, or if you're bootstrapping the company, could be one of the biggest advantages because you're not getting dilution with every new investor that's joining.
Yeah, I agree with that. I would say that most people are going to balk at first if you offer them a 6-year vest off the bat. 4 years really is the industry standard. And so if you want to do something different, having a compelling reason and being able to tell a story why, like you think it's going to take that much longer and you really want people to be there for the long haul, maybe they'll be able to come to terms with you. But I do think most people are going to expect that 4-year.
I'm on the same page with them.
And we unfortunately are out of time. I'm sure our panelists would love to answer all of the rest of your questions off stage, but join me in thanking them on stage as we wrap up. Thanks, everyone.